The reality is that the vast majority of professional mutual funds underperform the S&P 500 over extended periods of time, which basically means the S&P 500 might make 10%, but your mutual fund is likely to make less than that, maybe 9, maybe 8, maybe 7. And from there, you have fees taken out of that, which is going to drop your returns even lower. So it is very costly, and returns tend to be quite low. Now, the bull trade itself, we, as well as the mutual funds, use the S&P 500 as a benchmark. And the bull has historically outperformed the benchmark virtually every year since 2002. Therefore, it outperforms the vast majority of mutual funds, and it also outperforms a vast majority of the much more complex, high probability strategies. The bull trade actually does very well against them most of the time. Something to think about. It's very simple, non-subjective, and it does extremely well.